Now, as we pivot towards storage and activity in the U.S., we want to look at the key mobility fuels, which, as we talk about, is gasoline, jet fuel, distillate, residual fuel. And you can see here that we had 14.763 million barrels a day of demand last week, and this week we're at 14.656. So we never crossed that 15 million threshold when we thought we were going to likely cross it and then, come back down, try to probably hug on a 4-week rolling average closer to that 14.8. But we never really got there. And that's now as you look at the issues on a economic level, you look at the impacts from the current hurricane, you look at some of these pieces, it's unlikely we're going to get there, especially when we start looking forward at some of the new shipments coming into the coast, which are very much lackluster when you look at what is coming in on a shipment basis, which will put pressure not only on the rail side, but also on the trucking side. And then when you look at just the consumer in general, like we've seen it in Europe, one of the things that we've been talking about is that manufacturing contraction was started first. It's going to stay there. But the service side is the one that we saw a bigger decline, and we expected to see a bigger decline. But it even went through our estimates in Europe. It continued to fall faster in the U.S., and that's where we see that slowdown, which is only going to accelerate, in our opinion, on an economic basis, which, again, is just going to limit the amount of activity people are going to do, how often they're going to go out to dinner, how often they're going to go for an overnight or a day trip, because it's just the costs are prohibitive, and that's something that we see impacting and, again, keeping us, or I should say keeping that demand muted as we go into what is already a slower season. So again, it's just we're saying we're going to have your normal seasonal slowdown. It's just the rate of change of that slowdown is going to be a bit greater, driven by the cost of products and just the economic impacts to the underlying consumer. Distillate had a build of 1.23 million. We're still well below the 5-year average. We're above last year, but you can see just where the issues are. Pad 2 is actually fairly normal. It's the issue remains Pad 1. Pad 1 is 14.8 million below the 5-year average, a little bit above last year. But if we have a normal or even a little bit colder winter, there's going to be a broader problem when you look at storage, because it's just going to drive up pricing. And then, again, open up imports. So imports increased 75,000 barrels a day, still below the 5-year, but you're starting to see some of these shifts. And it's important right now to look at this, and we'll talk more about it in the segment 3, that east to west flow, which essentially coming from Asia, the Middle East into the Atlantic Basin, is closed still. But that's something that we're starting to see the arb getting closer and closer to reopening, because we are seeing additional volumes of Chinese product hitting Singapore, and then that kicks out some of the Indian product, and instead of it going over to Singapore, it finds another home. That'll start moving into the Middle East, and then the Middle East is looking to send product, and that flows backwards. So that's how you kind of get this walking back step into the Atlantic Basin, which is going to feed both the European as well as the US markets. Now, one of the things that we've talked about is that diesel had kind of this last hurrah, and we didn't understand some of the strength in the paper crack spreads. And it's interesting because, through a friend of a friend, we were talking about some of these physical pricing, and it's like when you look at the coast, and he was kind enough to provide a picture. So for those that don't follow him, he is 60 Seconds to Know on Twitter. I highly recommend following him. He has some great insights in terms of just where prices are. And this is giving you an idea. So when stocks are usually a concern, and you have a tight and are tight, typically the cash and paper differential blows out with the crack. So you see this kind of follow through. We're not getting that. And it's interesting because when you look at the screens, we're probably a penny to 5 cents lower than what is out there. And it's not saying that we're in a big storage surge. It's just there's enough product on the market where if somebody wants it, they can buy it. But it's also high enough, and interest rates are prohibitive when you look at some of the storage, where it's like, well, we're in a backwardated market. I'm not incentivized to store additional. So it's not like we're going to flip into contango. It's just the steepness in the backwardation is going to flatline. And right now there's enough to satiate, which is why we see kind of this back and forth, which puts us on the sidelines. Because I was joking with someone on Twitter where you had everyone was like, oh, go long crude. It's like, well, the better play is to go long diesel. And now, in our opinion, as we talked about last week, is that that played out, and now it's time to kind of sit to the sidelines and reassess as we come into shoulder season, as we see the ramifications from not only just this hurricane, but some that could form behind it, and what those impacts could have not only to crude production, but refining, and then ultimately demand. Now, when we look at pad 1, again, it's in a bad spot. Let's be fair. If there is a problem, if we get a nice little snowmageddon, polar vortex, prices are going to go up aggressively. That will open up the import market. But even last year, we had the comfort of the Russian imports. Those are now gone in a meaningful way. Now what? And that's where we're going to see some of these different pivots, which is why you have the Middle East exporting so much product. A lot of this is going to find its way into the Atlantic Basin and ultimately both the U.S. as well as the European markets. Now, when we look at pad 3, it's important to look at where we are versus previous. So when you look at 2018, 2019, you can see that we're kind of right where we have been in previous years. And this is going to be, we think there's a little bit more downside to, we should say, we believe that there's going to be some additional builds here because there's downside on the distillate exports. And based on crack spreads, which, as we talked about, have weakened, they're still strong. I mean, there's no reason a refiner wouldn't try to make distillate at this point. Even though some of the things are below screens, the screens are still strong. So again, you're going to do it. So that's why we do see some of those builds as the exports can slow a bit. Then when you look at demand, again, still well below, we'll likely get a bit of a spike. But as you can see, we normally get a spike this time of year, so it's still going to disappoint when you look at the broader scope of activity in terms of where things sit today. We look at trucking demand. As we've been saying, it's going to kind of flatline. We normally get a little bit of an increase just because we had some of the early ordering. Now, it's interesting because we did get a nice little bump in shipments when you looked through the kind of that middle of July into August. And the question was, and Craig at Freight Waves had a really good question, and he said, is this people taking advantage of cheap shipping, or is this a pivot? And our view was it's people taking advantage of good pricing. They're going to try to order early for Halloween, Thanksgiving, Christmas in terms of ordering, back to school. But as that whittles down, we don't see much follow through. And that's really starting to play out when you look at the activities that we've seen so far in the trucking world. And then following on what is coming through from the coast. So then when you look at rail, when we pivot over in terms of where some of these charts show. So here, if you look at last week, last week we had intermodal that was down 4.6%. This week we have intermodal down 7.7%. And that's what we've been seeing and saying is like you're starting to see some of these pressure points. Petroleum products are still strong. Motor vehicle and parts are still strong. That's not going to change. But total car loads are down 3.9%. And a lot of that is being driven by forest products and grains, which based on our yields are going to continue to underwhelm in comparison. But intermodal, and now the drop from 4.6 to 7.7, we don't see much turnaround in that. Now, it could have bounced to down only 6%, sure. But year to date, on an intermodal basis, we're down 9.2% versus last year. And last year, you had a strong start to the season, but then you dropped off quickly. So the comps aren't that hard. And again, you're just seeing more of that pressure. And for us, in our view, that leads to a slower, that's showing a slower consumer, other pressures. And this is what we were talking about when you look at the coast, what's coming into that West Coast market. And you can see things are very much underwhelming, and we don't see too much change. We saw some drift back in terms of September. If you remember, we had over 100,000 cargoes expected. I should say 100,000 TEUs. That's fallen away. So again, that's going to be a problem. We have a nice little heat wave that's going to come through. For those looking into next week, it'll be a nice little warm start, and then it should break based on if you go out the next few days. But you can see that little heat dome is kind of sitting right over that northern Texas up and through the Great Lakes. So a little bit more time to take advantage of the summer weather, especially for places that get some biting cold. And you can see the divide line is the Rockies. Everything essentially east of the Rockies is seeing some above average temperature. Everything west of the Rockies is seeing something a bit colder. And this is giving a little bit of support into the natural gas markets. So here, when you look at gasoline had a small draw of 210,000 barrels, which, if based on seasonality, that's actually quite low. And that's why you were seeing that sideways move. So yes, we're 11.5 million below the 5-year, but we're 2.9 million above the last year. We had builds across the board in pad 1, pad 2, pad 4. Pad 3, small draw. That's likely a little bit of pull through to make sure that things were situated as you go into pad 3, into pad 1. Make sure that that's available as the hurricane passes, and we tried to restock the system. Make sure things are situated, but again, that's just going to show maybe some draws. But realistically, imports are remaining elevated. Imports were down 45,000 barrels a day, but they're still well over the year over year, well over the 5-year. And there's still some residual. Now, the problem is, after that residual passes, you have a sizable drop just because then the ARB's closed. So you have what's there, and then there's going to be this kind of gap. Now that could reopen because you are seeing a little bit more opening given what is happening with the hurricane right now, but that also drives up shipping rates. So that it's, again, kind of mitigates some of this. We should see a little bit more bleeding out, but not to the same degree, especially given seasonality is over. The seasonality trend is working against you, but Europe is sitting on a massive amount of gasoline that they have to do something with. So when you look at the blending components was down 1.45 million. But finished motor gasoline was up 1.24. So again, kind of balancing each other out here, and we don't see too much of a shift in general. When you look at blending components, even with the draw, we're over where we were last year. We're over the 10-year average. And it's just, we're going to manage this in general just because you're going to get some of those other oils getting blended into this. And what we see is just essentially running straight into that yellow line. You see where you have that sizable drop at the end of September? That's typically when guys try to dump their summer grade or do something else with it, because now you're moving into winter grade. As the October contracts start to trade, you're tapped out. You can now start making and selling winter grade, which is cheaper, doesn't require the same amount of components. So again, we do see that getting more quote unquote normal. So then when you look at Asia Pacific, things are moving along seasonal lines. Europe is also bouncing versus where it was in 22 and 23. But you can see that the trend is actually starting to bleed a little bit, and things aren't coming back as quickly. The U.S. is interesting because typically you get that last final bump. Instead, you had a little bit of a rollover because that bump is really driven based on Labor Day. Then you have a nice drop, and then you kind of snap back to normal. We won't get the same pop. We will get that drop, not to say pop and lock, but again, that pop down a bit. And a lot of that is going to be driven based on the hurricane and a kind of a muted Labor Day. So again, we do see some recovery in European demand, but it's happened the last few years. Same with North America. We're going to have a little bit of an increase, but nothing really major, especially given that in office activity continues to be on the lower end, especially in a lot of the major cities. Then when you look at pricing, diesel prices continue to move up. Gasoline prices have come down a bit. There's going to be some support in the near term on gasoline prices, but you can see that they're leveling off. The diesel side is the problem for companies, for organizations. The diesel, and this is why when we looked at August inflation is going to be a bit tough. You had harder comps because remember the comps were the benefit of these massively elevated prices were starting to die away on a year-over-year level. That's going to weigh in on kind of what the averages are and what that year over year looks like. We know month over month has been aggressive and hasn't ever really gotten better. This is, again, going to show some of that acceleration, which is why we do think the Fed has one more of those rate hikes. When you look at 2020, you can kind of get an idea of where we are. You had that nice little bump for Labor Day. We think it's going to be a bit muted, but even still, that's going to fall flat against the 10-year when you look at the normal activity, which is why, again, we said that we thought we were going to get a little bit closer. Haven't really gotten there, and that's something that's going to continue to weigh. Now, it's interesting because when you look at the activity levels, the expectation and what was announced when you looked at demand was in terms of from the EIA, we had 9.068. Now, when you looked at Gas Buddy was modeling about 8.86. The shift between the two is likely product getting pushed out from the rack into the retail market before the hurricane. Gas Buddy's probably closer to right, and then it's going to be a matter of how much of that. So that's a little bit of a bump. So you can see that things are actually a little bit worse than even what was posted. So we don't see too much saving grace on the gasoline side. Propane, big build of 3.18 million, 17.4 million over the 5-year, continuing to set highs going back to 2015. It's keeping us competitive, which is why our exports will stay strong, but we don't see too much benefit in domestically. Jet, it's had a small draw of 720,000, right along the 5-year average. We did get a nice little bump in jet fuel movements, and demand, but typically you get that bump ahead of Labor Day, and then you get that pretty steep drop off. We think the drop off is going to be pretty accelerated, and we're still comfortable with that 1.55, 1.65 million barrel a day range. Yeah, here you can see that a little bit of a drop off in terms of flight schedules. It's a little bit harder to see here just because of the thousands and what that X and Y axis looks like. But here I think it's easier to see that you're seeing that trend to the downside. And again, it's not huge. It's just when you look at 1,000 flights a week, you're seeing we're going from 760 to 750 to 740. So it's just seasonally normal, nothing crazy in that regard. And you see it in the TSA data. The TSA data, you're seeing a fairly sizable drop. Typically, Labor Day, a lot of people drive. They stay fairly close to home. So we don't have a lot of flight activity, so that, again, we're just almost tracking it perfectly. And the same can be said within Europe. Now, this is, I think, a better gauge of kind of where the consumer sits in the U.S. You can see that eating out has progressively gotten worse. Before, we were only down 2 to 3% versus normal. Now we're down 5 to 6%. Globally speaking, something similar. We were only down either flat to only down 1%. Now we're down 4 to 5%. So again, I think this is showing kind of the bigger pain at the consumption level, which is pointing less towards consumption, less towards gasoline demand, and again, that weakness in the distillate market. So that's what we have for you on the U.S. side, on the demand front. In the next segment, we're going to go deeper into what's happening abroad, especially when you look at those physical markets on the refined product side, as well as the crude front.